Over the past 3 years, almost 2/3 of IPO companies are in the red. In other words, they are lower than their IPO price, which is not a surprise because if you follow us for a long time, you will know we always tell our viewers, we always tell you that most companies that go IPO, the fundamentals are a little bit overstated. And then because of financial interest, there is also a big desire for the valuations to be higher. So you've got heightened fundamentals and heightened valuation. And so it's no surprise. In fact, I'm a bit disappointed it's not lower. But anyways.
Yep, exactly. And just for the context, right, it is starting from January 2022 all the way to 4th of December 2025.
So it's almost 4 years.
Almost 4 years. So this is the top 10 companies that reported the most losses since they have listed in Malaysia. So you have no surprises, there's a few tech companies that we see here. Some of them are related to retail distribution, but you can roughly take a guess and you can know that it's about 70% comes from tech. So you have Opstar. This one used to be a darling when it's first listed because it went up on the first day. But since then, it's down 85%. DD Vision also, they did pretty well. Same for Kuchinko. Cape EMS also did pretty well. Whereas the others are like construction related, retail related.
And notice we use here the closing price of the first day. Now, of course, earlier on I mentioned IPO price. So you might be thinking, hey, MJ, that's not fair. But in fact, if you do the math, like for Opstar's case, it went up 3 times. But if it drops 85%, it is actually still lower than the IPO price. However, the second lesson, if there is one, is that never buy on the first day, pretty much.
Or you can just sell it on the first day.
If you have the shares already. I think there are 2 ways, right? If you have the shares through your balloting, good for you, right? It's, I don't want to say it's free money, but it's close to it. The second option is you day trade, right? Within that day, you try and see, how, you have to probably do some sort of technical analysis. And the third option is to stay out. Because I think if you were to buy on the first day, especially if you have no intention of selling in the long term, it's quite destructive.
So what exactly happened to these 10 companies, right? Well, we have actually break it down into 4 key main points. So the first one is MJ. We just now mentioned that there's overstated in numbers because usually companies, when they go IPO, they want to make their numbers look very, very nice, that there's some sort of growth. And then they'll promise you with the money that they're going to be raising is going to be adding into more growth to their company. So Buffett also got say that he's very skeptical about IPO companies and he sees it as a hype and animal spirit because people just love IPO companies. Is very hot. Usually when they list, right, they want to list it when it's hot so that they can get a higher prices as for early investors and also for the promoters. So
it's just all the financial interests are aligned, right? So the early investors, obviously, let's say the PE funds or VC funds, they want the exit to be really big. The second thing is the promoters. Now the promoters, I would say, is not just the CEO or the founder, right? Obviously, they want a high valuation because they think their company is valuable. But the other group would be the investment bankers, right? They have an interest in, getting it as high as possible. So these 3 big investors, founder, and investment banker, that's who you're up against.
You also need to know that there's a portion of shares is being allocated to like private investors, some of the private placement holders. So they will benefit on the first day and they could be the one that is selling off because they are not being restricted by the moratorium. So that is something for you guys to know. The second one, which is an expensive valuation. So you can see over here, there is a couple of companies which is related to tech companies and some retail like Seng Heng, right? They all, when they first listed, their fees are quite, obviously on surface, it looks very expensive, 28 times to 31 times. But if you look at other companies, like tech companies, Opstar, TT Vision, right? They are all like, I would say, close to fair because that is the valuation that you'll be paying for that company. So I would say that valuation, it depends. Some companies are quite okay. It's quite fair, but some like Seng Heng one, this one.
So let's use some common sense, right? So, I yesterday I just went to Seng Heng, right? And the deals that they give is really, really good. So of all the valuation here, yes, for sure it looks a bit richer. However, it's not crazily rich. But let me give you one big example, right? You look at Opstar Division, all these are, related to tech. And their valuation, we will already consider a little bit frothy, right? Almost 20 times. But take a look at MST Golf, for example. How is it that they can have a higher valuation than, say, Opstar, right? Especially when they're in, Opstar is in chip design, right? Related. Same with TT Vision, this is your testing equipment, things like that. So, and as well as Senheng, right? If you compare it, right? Senheng, so it's quite dominant, right? And MSD Golf is, one golf. I mean, maybe golf people can educate me. But when I did my research talking to some golf people, they say like, look, yeah, I mean, MSD Golf is not bad, right? But I don't have to buy it for them. Sometimes they give good deals. But you see, that's the key thing, right? Like I go on to MSD Golf because they give good deals. What does it mean? It means that there is a lack of some sort of pricing power. So just one observation I want to make here based on numbers.
Yeah. So the third one is, this is a very rare case, but if you notice that there is founders that start to pledge their securities, especially in IPO prospectus, right? You mentioned this. Then you need to be very careful because you never know whether they are using that account to actually really take like a loan and they collateralize their own shares. So in this case, it happened to Cape EMS Berhad, and the founders got margin called, and that's why you see there was a steep fall over here. So I would say this is a very, I'm not sure whether is it a rational decision or she's just being very unlucky, the timing wise. So yeah, but it's definitely some signs that you should be paying attention to very, very closely if they do have like pledge accounts, especially. Okay, last but not least is they fail to compete in their industry, or the fundamentals are just getting worse and worse. So in this case, we have ECA and also Opstar. These two also are related to tech companies. ECA is more towards automation solutions, kind of like AE-related service provider, whereas for Opstar is related to integrated circuit. So if you first thought about it when they went for IPO, you would be thinking that, hey, if you look at companies like Pentamaster, Vitrox, they are all like profitable and they are growing. But how come, Opstar and ECA didn't? So yeah, that tells you something, whether is it to do with their management or it's just their core business is just fundamentally there's some sort of flaw, or they are not doing something right.
Yeah, and if you look at this, right, it's so crazy how I don't like to say that we good at predicting. However, if you notice every time in our IPO videos, when it comes to the financial section, and remember, this is all leading up into listing, right? So they have not actually started behaving like a listed company yet. And if you look at the numbers, it's always one direction, right? Seldom I see there's a drop. And if there's a drop, there's usually some sort of explanation of why it's a drop or whatever. So how is it then that after that, the numbers start to deteriorate, like almost immediately, right? Opstar listed in what, 2020?
Yeah, 2022, 2023, around
right?
there.
And then suddenly, just a couple of years, and then it's like complete flip. Now, no doubt that there are fundamentals in terms of like the macro environment with tech for sure. But okay, Opstar can get away with it, but how about all the other companies, right? You can go and chart it yourself. So this is one lesson here is, expectations are very important, right? So when people IPO, expectations are high, right? They have to gong, they have to hit a gong and things like that. Everybody's excited. And usually there's a disappointment. Of course, a company that sort of bucks this trend right now is 99 Speedmart. They are a bit unique. I think you can sort of put Dutch Lady there as well. But generally speaking, this is the issue, right? When they list, the numbers look fantastic, and then just a few years later.
Oh, you mean Farm Fresh, right?
Farm Fresh, sorry, not Dutch Lady. I bet. Just a couple of years later, suddenly it becomes more realistic. And I can tell you, I've been at a company that was going through a listing process before. I cannot share all the details. However, what I can share is that there's a lot of attempt to like categorize and recategorize certain sales, certain earnings and expenses. And it's just a natural thing, right? We're not accusing anyone of doing this, but it's just natural that they will want to push the expenses of whatever they are analyzing now before listing to after listing. So if they find some sort of accounting ways or tricks just to push the expenses forward. Now, this is not necessarily illegal, right? It's all within the rules, but this is the game that they play. And of course, all the revenues, let's say if they list on 2025, let's say they're listing 2025, revenues from 2024, they'll try to sneak it in, they'll try to justify to but actually, the service was rendered in 2025. And then next year's revenue, 2026 revenue, they try to say, oh no, actually we started work already this year. Starting work can be sent an email. so then the revenue gets booked. So 2026 and 2024's revenue gets put in, then 2025's expenses get pushed out into the separate years. And that's how you get like the numbers very nice.
Yep. So there's some sort of accounting tricks. We also did a video about this. You can check it out over here. So another honorable mentions that we didn't stay because their share price went up for a couple of years or maybe few months after they listed, but thereafter it went down eventually. So these companies are SFP Tech, Infoline Tech, and also Synergy Berhad. So it's also due to fundamental reasons. They cannot really continue to grow in terms of their revenue and also their profit, especially for SFP Tech. It used to be quite hot alongside with SAM Engineering. Initially, these two are going head to head. When you see SAM Engineering share price is going up, they also somewhat like they will be benefiting or something like that. But I mean, as time goes by, true enough, their numbers didn't really like deliver. And I think right now they are facing some sort of like they are losing some lesser order or lower demand from their customers. So yeah, that's why it's not doing so well, especially for SFP Tech over here. So we also have a couple of companies that recently just went for listing. No surprises.
Yeah, the ing is the gong is still gonging and it's already.
Yeah, even today also there's this company called BMS that just went for IPO and it's down like I would say 15%. Yeah, so after they gong, they have to see their chart.
It's a standard. It's like very few things in the stock market are predictable in the short run, but IPO companies there's some predictability.
Yes. Okay, so not on all of the IPO companies are bad. We also have the winners over here. So these are the top 10. And if you look at these names, right, you already kind of can tell that which industry that is really striving or benefiting these companies. So we have the data center, and then we also have the renewable energy, and also pawnbroking. You also can say some construction company that is doing very, very well. But mainly it's have to do with data center and also renewable energy initiatives. So if you notice, right, MN Holdings related to data center, IT is related to CCTV because we also need more CCTVs if you compare with developed nations, right? Mastertech is related to data center. Ifomina Tech somewhat related to AI. KGTS is more related to renewable energy. Elwich also is the same. SNS is related to AI. This is construction. This is gold. And then this one is just a fire extinguisher, which is quite interesting. But they managed to still grow their earnings, which is the reason why their share price still went up.
Yeah, and there are as well. Even the latest one, right, which is like Papa Jack, 1st April. No, sorry. Yeah, Papa Jack, 1st April, right, 120% in 3 point something years, right? So that's over 20% return.
Yep. And you also look at the E's, right? It's not to say that they are cheap. I mean, if you look at on first glance, for instance, like ITX over here, I think even though after you read the prospectus, you wouldn't really want to subscribe to this company just because it's at 37 points.
But that's kind of like our bias, right? That's the way of doing things. But if I were to chart the profit numbers or at least the sales numbers, I think they're all up, right?
Yes.
That's key.
So yeah, that's very important, is whether you understand this industry, whether is it growing positively, is it growing steadily, or is it going down? So that is the main key thing that you need to take note. So the final takeaways over here is obviously you will have a higher hit rate if let's say you sell it on the first day, regardless if you sell it during the open price. Like let's say once it listed right at 9 a.m. you hit the sell button, you will make like a 71.4%.
This is assuming you get
assuming you get the shares, correct. And also, if let's say you sell it in the closing price, you also will be making a decent hit rate. It's like 72%. So essentially, which means is that, if let's say you decided to not hang around with this company, or you want to see whether they can really prove themselves that they can deliver the numbers, then probably selling on the first day could be the best move over here. Second one is there's a pledge security risk. So if you see any founders that does that, I think right now because of this case study from Kate EMS, more and more founders are more cautious in pledging their shares. So if let's say you do find one IPO company that does this, right, I think you need to be very careful about that. Third one is revenue and earnings growth is the main priority that you should be focusing on more than the valuation. So IT Max over here, he has still been growing very, very steadily. Profits also have been more than triple already. So which is also the reason why their share price have more than triple. So yeah, this is very, very key. You need to know whether this business can continuously grow or not in the future. And last but not least, there's a couple of companies that actually went up a lot. So for instance, like IAB, Insights Analytics, and also these two companies, especially we covered it in our IPO analysis. You can watch it over here. And also Cheating. So these three companies, their share price went up like 90%, 70%. I think THMY went up quite a fair bit. I think it's almost like 2x to 3x of its share price. But it kind of feels like the Opstar days again. It's like, you see that the numbers are there, or at least the share price is going very well, but we still don't know whether they can continuously deliver what the market expected them to deliver. Because so far, the story seems very, very interesting. But in due time, we also will be revisiting them to see whether can they really deliver the numbers or would they be the Opstar 2.0.
Yeah, we share a lot of these things in our FIRL Pro program. We do a lot of write-ups, educational write-ups for people to understand what we just shared. And in fact, all this information has been shared to our members, months ago, or at least, not all at once, but across the board. And some of these companies that we cover has done pretty well. Some, of course, it's not perfect. Not everyone of them does do well. And what is FIRL Pro? In essence, it's our way of helping you shortcut your research journey. One very cool part about FIRL Pro is this thing called management notes. It's just a way for us to give you information about different companies that are quite hard to find, their information, quite hard to find on the internet. So if you want to really get a leg up in the stock market in Malaysia, do consider hopping onto FIRL Pro, and it's money back guarantee in the first 10 days. You check it out for the first 10 days, you don't really like it, you just ask us for a refund. All good. No questions asked, except for feedback. And if you want to get a taste of what's inside, just check out our free sample link in the comments section and description. See you in the next video. Bye-bye.